Hello and welcome, everybody. I'm Vern Cushenberry, your Chief Investment Officer, and I'm back with another quarterly update. Little background on myself. I've been doing this for a long time. I've worked with some of the largest pension plans in the world. I serve as an adjunct professor, and we do this with over 100 advisors that we serve, and I chair an investment committee that gets together weekly to review massive amounts of data, and we try to distill that down into useful nuggets during these presentations. Call this sifting through the noise. So before I jump into that noise, I want to give you the bottom line up front, which is that the markets have done very well. We still see pockets of opportunity, nothing that would deviate from a long-term buy and hold, stay the course, very boring investment strategy that is designed to benefit from periodic rebalancing, whereby we institutionalize a buy low, sell high approach. That's what diversification, that's what rebalancing does. So if you're on course and are the high level type of investor that wants to check out at this point, I give you permission to do so. Elsewise, let's dive in. This is our returns for the third quarter. All of this data is as of September 30th, 2024. You can see the markets here did very, very well. Did want to point out that global markets, you look at global markets here, you can see international up 7, emerging up 8.7, global real estate up. Some of the bits of opportunity that I wanted to point out that naturally benefits from rebalancing when the United States does well as it has for a while now, that can create disparities in value and opportunities to benefit from rebalancing. And investors have that right now in global stocks and in fixed income, both of which performed poorly last year. And I'm going to give you some more data on that. But first, let's look at this next chart that shows the S&P 500. I share this every quarter. You can see we're at nearly all-time highs. The big news in the markets over the last few weeks is that the Federal Reserve has started lowering interest rates. That should benefit the housing market, hopefully make that a little bit more affordable. And to put this in context, I always share this chart, which breaks it down on a relative valuation basis. And you can see here that the market typically fluctuates between, well, we're looking at price to earnings here, between 19 on the high side and just call it 13 on the low end. This is where the 30-year average has been at 16. And we're looking a little bit pricey at the moment. I wanted to share this next chart to give you a little bit more information on those comments that I made about the global markets. This chart shows the international price to earnings discount versus the United States. Now, what's that mean? Well, it means that typically international stocks are cheaper than those stocks that trade in the United States because investors globally recognize that we have one of the best regulatory systems in the world, and that allows for stocks to trade at a premium. So international stocks would trade at a discount, and on average, that discount is about 17%. And we're tracking this data back to 2004. And you can see that there are different periods of time where that discount narrows and periods of time where that discount widens. Well, as of September 30th, that discount was at a 35.9% threshold. And what does that mean? Well, that means that international stocks are cheaper relative to domestic stocks than they have been in the last 20 years. So again, that represents a pocket of opportunity that will benefit investors that are adhering to that disciplined approach of quarterly periodic rebalancing. I wanted to address the most common question I've gotten in the last few weeks, which is about the election, and that's on everybody's minds. And I have a tendency to think of elections as more noise than actual information. Notwithstanding, we can look at the official websites, official campaign platforms, and discern different stances on taxes, trade, immigration, energy, defense. Again, I've been doing this for a long time through a lot of presidential administrations, and my rather maybe cynical view at this point is that what is espoused during the campaign period, is rarely what actually gets passed through Congress. So I try to take this fervor with a little bit of a grain of salt and maybe a level head and a broader perspective. And when we zoom out to take a look at that broader perspective, I think you'll find this chart useful, which is by my friend Carl Richards. You can see here that most of that is noise. A pocket of it is real information. And then that little dot at the bottom of the screen is stuff that might actually be useful. And you can see that manifest here in the, call it the 50,000-foot view of the markets across all administrations, with the clear point being that regardless of Democrat or Republican administration, the markets have a tendency to do what the markets do, which is compact capital over time for the benefit of investors. Okay, next I want to look at tech stocks, because tech stocks have done very, very well. And for, again, investors that are patient and rebalancing quarterly, we now have the opportunity to benefit from a little bit of a reallocation, away from the stocks that have done so well in the last year and, into cheaper sectors of the market. So this chart looks at the price to earnings ratio of the top 10 largest companies in the S&P 500. Earlier this year, I shared a slide called the Magnificent Seven. These are those stocks. So we're looking at, well, it's right down here at the bottom of the screen. We're looking at Apple, Microsoft, NVIDIA, Amazon, Google, Meta, Berkshire Hathaway. It's the tech sector is what we're looking at. And when we look at those top 10, we can see a current price to earnings ratio of 30.5, with an average over the last 30 years of 20.5. Now look at the remaining stocks in the S&P 500. So this would be 490 stocks remaining. So excluding those top 10, we have a price to earnings ratio of 18.4, much more reasonable. I've been getting a lot of questions from our investors about valuations and are the markets frothy here? Well, you can take all that froth out of the market if you just sell away from those tech stocks that have been the driving force over the last 12 to 18 months. So I thought that was very interesting and worth sharing this quarter. The other data point on this chart that I wanted to share would look at this. This shows research and development expense. 41% of all research and development expense for all companies in the S&P 500 was spent by those largest 10 companies. Here's another manifestation of that. This time we're talking about capital spending. So property, plant, equipment, think fabrication facilities that build the chips. This chart on the left shows capital spending. Capital spending is now projected to be $200 billion this year and over $200 billion in the next 2 years, and probably throughout the forecast period for these largest companies in the S&P 500. Here we're looking at Alphabet, Amazon, Meta, Microsoft, Oracle. That's an incredible amount of capital expenditure. Okay, last slide, and I roll this one out a couple of times a year because it's my favorite slide in any deck that I'll ever share, and it's an investing principles slide. And my experience has taught me that this has a very positive effect on the outcomes of all investors, because it forces us to recognize the power embedded in a patient approach and in a disciplined approach that rebalances your portfolio to take advantage of those lower priced securities and to sell some of those higher priced securities on a quarterly basis. So what we're looking at here are the returns to stocks and bonds in a balanced portfolio dating back to 1950. And in this first column, we're looking at a 1-year rolling return. So if we look at any 1-year period dating back to 1950, what we observe is that stocks have, on the low end, returned a negative 37%, and on the high end, returned 52%. So it's a very volatile asset class. Bonds, a little bit less volatile, negative 13% to 33%. And then a balanced portfolio, as you would expect, somewhere in the middle, down 20% to up 34%. So these are not the types of investment returns that create long-term success, but a disciplined portfolio, a patient portfolio held over a 5-year period. Well, you can see what happens. Stocks, the worst 5-year period stocks have had dating back to 1950 has been down 2%, 29 on the high end. Bonds down 2%, 18 on the high end. A balanced portfolio has never had a negative return dating back to 1950. So that gives investors a lot more confidence in putting money to work. Look at a 10-year rolling period. You can see the balanced portfolio's returns. That dispersion gets a little bit tighter. And by the time we zoom out to 20 years, even stocks have never had a negative 20-year period. Thank you for your time. I look forward to seeing you again in 3 months.